Since the 2008 market crash, we have experienced tremendous growth in our markets, and many believe that the current run is losing steam. US stocks have been going up for 6 years now. That's a lot longer than the typical bull market cycle, which usually lasts 3.5 to 4 years. So how much longer can this upswing last? The Fed is likely to raise interest rates in the coming months, but that isn't necessarily a negative for stocks. In the last 20 plus years, the Fed has only had 3 major cycles of rising interest rates, beginning in 1994, 1999, and 2004 respectively. In each case, the stock market went up in the months before the interest rate hike, had a short-term correction of roughly 7%, and then started going up again with a significant rally after the correction. Another factor to consider is stock market valuations. On March the 2nd, the Nasdaq hit the 5,000 mark for the first time since 2000. As we all know, this was quickly followed by a sharp decline and talk of a bubble. But the Nasdaq is still up over 3.5% for the year, and there are some important factors that differentiate this time from 15 years ago. Low interest rates allow companies to borrow cheap and create shareholder value via shareholder buybacks that might be more difficult in a high interest rate environment. In 2015, we have already seen share buyback announcements from several big players on the Nasdaq, including Qualcomm, Gilead, and Comcast, to name a few. These 3 companies alone combine to account for nearly 5% of the Nasdaq. I don't see this letting up. Looking globally also gives us more reasons for investors to remain bullish on US equities. An aggressive quantitative easing policy is being implemented in Europe, which has resulted in a dramatic rise in equities. For example, the German DAX crossed the 12,000 threshold on Monday after crossing the 11,000 level in January. Similarly, Japan has stated its intentions to continue an aggressive QE policy in 2015, aiming to inject 6.65 trillion yen each month. With European and Japanese companies doing well, we can expect to see that money trickle into US equities as foreign sovereign funds begin investing in US companies. Even the surging US dollar probably isn't as bad as some claim. In the days of globalization and the ease of outsourcing and cost cutting, there are countless ways for multinational corporates to cut costs and maximize profits. The concern of a strong US dollar impacting multinational performance is surely overblown and can easily be addressed by management rather than being cited as an excuse in quarterly reports and conference calls. We always talk about the current state of the markets either being in a bull or bear state. We feel that we will continue to experience an ongoing bull market with pockets of volatility.